Let's jump right into this explainer. We're breaking down the structural turnaround of KHAITANLTD India Limited, projecting out to April 26, 2026. We are literally watching a legacy brand at a massive strategic crossroads here, completely moving away from its roots in capital-intensive manufacturing.
Section 1. The Strategic Pivot. Let's look at the fundamental state.
Tracking the evaluation window from 2021 through 2026, the fundamental state of this equity is currently categorized as stable. But here's the fascinating part. This stability didn't just happen by accident. It is the direct result of a profound, highly deliberate operational shift they've been executing over the last 5 years. And market sentiment? Well, it's turned aggressively bullish in just the last 48 hours. The stock surged over 16% to close right at 140.54 rupees. That definitively broke through the 135 rupee resistance level. So with high volumes and technical breakouts, we're seeing strong signals of institutional interest in this evolving story.
To really understand why this sudden breakout is happening, we've got to define the main catalyst here, which is their transition into an asset-light trading ecosystem. For Khaitan, this basically means minimizing capex by completely walking away from heavy manufacturing. Instead, they're monetizing their well-established brand equity through trading and royalties. It's a real game changer.
The contrast before and after this transition is just striking. They are leaving behind the capital-intensive, low-margin business of fan manufacturing, which, honestly, is just fraught with intense competition. The future for them is a zero-capex brand royalty model. Management has strategically decided to abandon those heavy factory overheads to unlock the pure underlying value of the brand itself.
Because of this, their revenue mix is drastically transformed. We're talking nearly 90% of operational revenue now flowing exclusively through the electrical goods trading segment. They are entirely bypassing the factories now, focusing completely on high-velocity items like cables, wires, and switchgears.
Section 2. Capital Efficiency Metrics. Let's evaluate those asset returns.
The dramatic impact of this royalty-based model is incredibly clear when you look at the numbers. It has fundamentally altered their capital efficiency. Historically, their average return on capital employed was a pretty sluggish 5.5%. But today, that ROCE has expanded to a very healthy 18.3%. Their capital is simply working way harder now, without the massive drag of factory upkeep.
Furthermore, management has actively cleaned up the balance sheet. The debt-to-EBITDA ratio has stabilized right at 1.5x. In the context of our analysis, this represents moderate, highly manageable leverage for a microcap that's in a state of active recovery.
And this financial stabilization? It's already showing serious bottom-line results, yielding a net profit of 6.98 crores for fiscal year 2025. This number absolutely validates their overhead reduction strategy. Shedding those factories is tangibly improving profitability and proving that this whole asset-light pivot was the right call.
Section 3. Bull versus bear case. Time to objectively weigh the risks and rewards.
The investment thesis here is really cleanly divided into a strategic matrix. On one hand, we're tracking accelerating operational tailwinds. Think zero capex royalties and national infrastructure alignment. But on the other hand, we can't ignore the lingering structural overhangs from legacy operations. Those, along with some governance concerns, remain a distinct and present threat to the valuation.
Let's break down the bull case first. It's anchored by a highly aggressive trajectory. We are looking at a massive 50% year-over-year revenue expansion in recent quarters. That zero capex royalty generation is finally unlocking those previously undervalued intangible brand assets. Plus, their strategic pivot to cables perfectly synchronizes with current national infrastructure booms. Finally, there's an anticipated dividend of up to 2 rupees that could act as a major, imminent re-rating catalyst. Conversely, the bear case focuses heavily on some very real structural vulnerabilities. There are significant governance risks here, specifically a hefty 32.85% in pledged promoter shares, which could easily trigger margin calls during a market downturn. On top of that, long-suspended sugar and agriculture divisions threaten severe asset wastage. That's a looming potential impairment right on the balance sheet.
But here is the absolutely critical context you have to keep in mind: scale. With a market cap hovering around just 67 crores, Khaitan remains a highly volatile microcap. Operating primarily as a trading middleman now makes them inherently susceptible to supply chain shocks and volatile raw material pricing. That severely limits their direct control over margins.
Section 4. Turnaround Timeline. Tracing the path out of distress.
So, let's look at the timeline. Following critical debt restructuring and the clearing out of legacy liabilities back between FY22 and FY23, their royalty-based brand model was officially finalized in FY24. That pivotal move laid the groundwork for cost-optimized logistics taking shape in early 2026. This leads directly to the recent volume breakout we just discussed, which perfectly aligns with an anticipated 55 crore revenue hit for Q4.
Section 5, the next 12 months. It's all about operational execution from here.
If they're going to sustain this aggressive momentum, there are two absolute requirements for management over the next 4 quarters. First, they have to continue scaling that high-growth electrical trading segment without a hitch. Second, and this is perhaps more important to institutional watchers, they must finally resolve the operational fate and potential monetization of those dormant legacy agricultural assets.
So, this brings us to the core fundamental question for this equity. Will the monetization of those dormant legacy assets become Khaitan's ultimate re-rating catalyst, finally unlocking that hidden value? Or will the inherent microcap supply chain vulnerabilities and the fragilities of just being a middleman ultimately fracture this turnaround? You really have to weigh the massive structural shifts against those lingering overhangs. Keep a very close eye on their next quarter. Thanks for joining this explainer.